boiler side and liquid cooling solutions continue to gain momentum as customers increasingly require highly engineered systems tailored to their specific performance and scalability needs. This dynamic aligns directly with BASX's core strengths: custom engineering, thermal management innovation, and speed. And it positions us well to grow with this increasingly demanding AI data center market. Our focus is now squarely on converting this demand into sustained, profitable growth through disciplined program execution and capacity readiness. AAON branded sales and bookings remained resilient in 2025, particularly in light of a 16% decline in overall industry volumes. Despite the refrigerant transition and the ERP rollout at our Longview facility, AAON branded sales declined just 8%, significantly outperforming the broader industry. Bookings saw even stronger performance, growing approximately 12%, driven primarily by national accounts, which increased 86%. This sales growth represents deliberate market share gains as customers increasingly recognize the total cost of ownership advantages our products deliver across their building portfolios. In other words, while we work through near-term friction, we continued to take share in the places that matter most and where our differentiation is strongest. Building on the operational foundation established in prior years, we advanced several initiatives designed to drive margins to optimal levels and support durable long-term growth. These included strategic investments in people and leadership, in manufacturing capacity, supply chain management, product development, and IT systems and infrastructure. Over the past 18 months, we have expanded our manufacturing footprint by more than 25% and meaningfully strengthened our leadership depth. Our investments in supply chain management will improve supply reliability, help reduce material costs, and improve working capital discipline going forward. These actions are practical, execution-focused, and designed to improve throughput, reduce variability, and enhance margin performance over time. Our focus on innovation drove meaningful advances in product development, most notably in support of AI data centers, where we introduced unique concepts designed to enhance scale, operating efficiency, and strategic flexibility. In 2025, we also became the first manufacturer in the commercial HVAC industry to commercialize rooftop units up to 40 tons with cold climate heat pumps that are capable of delivering reliable heating performance at ambient temperatures down to -20 degrees Fahrenheit. We also made significant progress in upgrading our legacy ERP system, which is critical to supporting long-term scalability. As expected in a transformation of this scale, when issues were encountered, we addressed them directly and implemented a revised rollout approach that prioritizes stability, customer deliveries, and execution certainty. We are sequencing remaining ERP implementations under a disciplined governance framework, with Redmond scheduled for the back half of 2026 and Tulsa expected in 2027. This approach reflects control and intentionality, allowing us to protect service levels while preserving the long-term benefits of the system. Alongside these accomplishments, 2025 included several temporary challenges, most notably the industry's refrigerant transition early in the year and incremental complexity from our ERP upgrade. While these factors pressured margins in the near term, they are well understood, largely contained, and do not change our confidence in meaningful margin improvement as execution continues to strengthen. Before turning it over to Rebecca, I want to share my perspective on how we ended the year. Bookings and backlog remained strong in the fourth quarter. BASX branded bookings again reached record levels, driving backlog to $1.3 billion, up 45% sequentially and 141% year-over-year. AAON branded bookings were also strong and increased 20% year-over-year, with backlog up 24% sequentially and 61% from the prior year period. That demand strength, paired with actions to improve execution, set the stage for a strong 2026. Operationally, production drove record sales. BASX branded sales more than doubled year-over-year, supported by the continued ramp at Memphis and strong throughput of liquid cooling solutions in Longview. AAON branded sales increased 9.5%, supported by a 42% increase in Alpha Class heat pump sales, and represents the strongest quarterly growth since the second quarter of 2024. Fourth quarter margins reflected differing operational dynamics across our facilities. Margin momentum in Tulsa moderated sequentially due to normal seasonality and temporary supply chain constraints that reduced production volumes. Redmond delivered stable margins, balancing productivity gains with targeted investments to support strong basis growth in Longview and Memphis. Memphis, though still a near-term margin headwind, remained on plan and achieved profitability for the first time in a quarter. Together, Tulsa, Redmond, and Memphis comprise the AAON Oklahoma and Basic segments, with Memphis results reflected in both. On a combined basis, fourth quarter sales grew 31% and incremental margins were a solid 25%. While incremental margins remain below our long-term target, they are improving and they reflect temporary pressures expected with ramping a new facility. With production volumes in Tulsa increasing materially in January and February, and Memphis continuing to ramp, we expect strong growth and accelerated incremental margins going forward. At Longview, which represents the coil products segment, Basics production and profitability remained exceptionally strong, while AAON branded throughput and productivity improved sequentially. Margins reflected this progress, partially offset by the impacts of a 5-day closure to support a wall-to-wall inventory at year-end. In summary, the softer-than-expected fourth quarter margin was primarily driven by lower production at Tulsa. With a strong backlog and production already approaching record levels, Tulsa is positioned to become a meaningful tailwind in 2026. Supported by robust Basics backlog and accelerating momentum in Longview and Memphis, we are positioned for 2026 to be a strong year for growth and margin expansion. We have a clear view of the drivers, our teams are executing, and we are confident in that trajectory. I will now turn the call over to Rebecca, who will walk through the quarterly financials in more detail.
Thank you, Matt. Net sales in the fourth quarter increased 42.5% year-over-year to $424.2 million. The increase was driven primarily by 138.8% growth in Basics branded sales, reflecting continued strong demand for data center cooling solutions and higher utilization of our Memphis facility. AAON branded sales were also additive to the year-over-year growth in the fourth quarter, increasing 9.5%, driven by higher production levels at our Tulsa facility and a favorable comparison to the prior year period, which had been negatively impacted by the industry's refrigerant transition. Gross margin was 25.9% in the fourth quarter, down from 26.1% in the prior year period. The modest year-over-year contraction was primarily driven by unabsorbed fixed costs with our new Memphis facility. Looking ahead, utilization and productivity at the Memphis facility continued to increase, and we are positioned for these capacity gains to provide meaningful operating leverage in 2026. As a result of these unabsorbed costs, fourth quarter non-GAAP adjusted EBITDA margin was 15.2%, down from 15.8% a year ago, and the fourth quarter diluted EPS was 39 cents, up 30% from the fourth quarter of 2024. Looking at the segment financials, beginning with AAON Oklahoma, net sales increased 11.1% year-over-year to $215.5 million. This double-digit growth was driven by a strong starting backlog and improved production throughput, which supported higher backlog conversion despite a challenging industry backdrop. The fourth quarter benefited from a favorable comparison to the prior year period, which had been disrupted by the industry's refrigerant transition. AAON Oklahoma gross margin was 27.5%, down from 30.7% in the prior year period, as a result of incremental overhead expenses of $6.4 million associated with the new Memphis facility. AAON coil product sales increased $49.6 million, or 93.6%, from the year-ago period, driven by $75.3 million in Basics branded liquid cooling product sales, which grew 100% during the quarter. AAON branded sales at this segment declined year-over-year 1.8%, but increased 15.2% sequentially as production momentum improved. AAON Coil Products gross margin was 21.3% in the fourth quarter, up from 16.1% in the prior period and 11% from the prior quarter. The year-over-year margin expansion reflected improved operating leverage on higher throughput at the Longview facility, along with a favorable mix of high-margin BASX branded sales. This was partially offset by a full 5-day plant shutdown at Longview at year-end to conduct a wall-to-wall inventory count. In the near term, BASX will continue to be a positive tailwind in dollars, but we do not expect product mix will be as favorable as we saw in Q4. Sales at the BASX segment grew 109.1% in the fourth quarter to $106.1 million. The strong growth was driven by sustained demand for data center solutions as the market continues to demonstrate strong momentum and the business captures additional market share, as evidenced by our strong order intake and increasing backlog. Increased utilization of our Memphis facility was also a significant contributing factor, providing additional production capacity that was additive to the segment results. BASX segment gross margin was 27.1%, up from 18.8% in the prior year period. The strong year-over-year increase was largely a result of a favorable comparison to the prior year period, along with accelerated production from our new Memphis facility. Turning now to the balance sheet. Cash equivalents and restricted cash balances totaled $1.2 million on December 31st, 2025, and debt at the end of the quarter was $398.3 million. Our leverage ratio was 1.77. In 2025, cash flow from operations was a source of cash of $0.5 million, compared to $192.5 million in 2024. Capital expenditures in 2025, including expenditures related to software development, decreased 3.9% to $204.9 million. Overall, we made substantial capacity and working capital investments to support our expanding backlog and ongoing market share gains. As return on these investments begin to materialize, we are positioned for operating cash flow to improve significantly in 2026, driven by higher earnings and improved working capital efficiency. That flexibility supports our continued growth investments, including planned 2026 CapEx of $190 million. I will now turn the call back over to Matt.
Thank you, Rebecca. Looking ahead, we enter 2026 with strong visibility across both brands and confidence in our ability to execute. That visibility allows us to remain focused on production, prioritize throughput, improve delivery performance, and convert demand more efficiently as we move throughout the year. The BASX brand remains the company's key growth driver, fueled by exceptional demand from the data center market and our differentiated custom design solutions. During the quarter, BASX secured a strong volume of new orders at attractive margins, with the majority scheduled for production at our Memphis facility as it continues to scale. This demand profile and production mix position us to increase output efficiently, optimize the fixed cost investments made in 2025, and drive robust growth in 2026. As utilization improves, we are positioned for the economic benefits of that scale to increasingly flow through to margins. The AAON brand also maintains strong momentum. Backlog at the end of the fourth quarter was up 61% year-over-year, reflecting strong demand across the business. While backlog levels and lead times remain extended, we are actively managing this through production ramp-up and improved execution across the network. Despite a soft commercial HVAC market, bookings have remained strong, underscoring the resilience of our business. Importantly, we are seeing improving operational cadence as we work through backlog and position AAON for stronger performance in 2026. 2025 was a year of meaningful structural change and strategic investment, building on AAON's strong foundation and positioning the company for sustained long-term performance. As we move into 2026, our focus shifts squarely to execution, leveraging that foundation, improving throughput, accelerating backlog conversion, and continuing progress towards our margin objectives. For the year, we anticipate sales growth of 18%-20% at gross margin of 29 to 31%, with margin progression expected to be uneven by quarter as capacity ramps and product mix normalizes. SG&A as a percent of sales is expected to be about 16%, and depreciation and amortization expenses are expected to be in the $95 to $100 million range. These expectations reflect our confidence in demand, improving execution, and the operating leverage embedded in our cost structure. In closing, I want to thank our employees, customers, sales channel partners, and shareholders for their continued support. We enter 2026 with clear priorities, improving momentum, and confidence in our ability to execute and deliver stronger results. With that, I'll open the call for questions.
And a reminder to our audience that it is star and one on your telephone keypad. Pressing star and one will place your line into a queue, and I will open them one at a time, and you'll be invited to pose your questions. Our first question today will come from the line of Ryan Merkel at William Blair.
Hey, everyone. Good morning, and thanks for the question. Matt, can we just start on the gross margin in the quarter? A miss versus your expectation. It sounds like Tulsa was the reason, but just clarify that for us. And then you made some comments about recovery in 1Q, and I'm curious in 1Q26 if gross margins can get back into the range you gave for guidance for the year, kind of in that 30% range.
Yeah, and good morning, Ryan. Thanks for the questions. So first touching on the fourth quarter margin, when we look at the driver, the single biggest driver of that margin kind of against expectation was around Tulsa volumes. And so our volumes in Tulsa had normal seasonality, which certainly we expected, but we had some additional supply chain constraints that put some pressures on the overall throughput and velocity in the quarter. I want to touch on the supply chain piece because I mentioned in the call, and you and I have certainly talked about this in the past, there's been a lot of investment that we're making to really strengthen the capacity and the sophistication in our supply chain organization. And a lot of that is to improve reliability. There's going to be economic benefits, certainly, from better purchasing strategies with our supply base. But most importantly, we anticipate strengthening reliability of deliveries to be one of the biggest drivers of our progress in supply chain. And so that's going to really help alleviate some of these, I'll say, speed bumps that we've had going forward. And so as we look forward, you mentioned on the call that when I think about the Tulsa volumes in January and February, we have accelerated substantially out of Q4 within our Tulsa segment. And when we think about what that's going to mean, it's going to mean a substantial benefit from overall velocities that are going to be able to provide us some of that margin uplift that we're expecting. That will be a little bit offset in the first quarter from product mix that we'd expect to see out of our Longview site. Longview had a very large contribution of BASX revenue, but as we continue ramping the AAON branded revenue in Longview, you will see some pressures in Longview. And so, net of that, there's a little bit of offset from Longview, but Tulsa will certainly be driving improvement into the first quarter out of fourth quarter.
Got it. Okay. So just the bottom line it there, the supply chain issues we've kind of been talking about, it sounds like you've got some plans there to stabilize that, and we shouldn't see that be an issue going forward. Is that right?
Yeah, we're getting a lot better visibility into supply chain performance. And so we, going forward, anticipate a lot of the noise that we saw in 2025 around supply reliability to abate. And so what I would say is while there were challenges in Q4, from a supply-based perspective, they were substantially lower than they were earlier in the year. And so we are seeing the incremental progress in supply chain stability, and a lot of that is reflecting the efforts and investments we're making in our supply chain organization.
Got it. Okay. Thanks for that. And then just on the guide for revenue for 26, just looking for a few more details. Obviously, BASX, the orders and the backlog is really strong. I'm curious, are you going to be in that kind of 40 to 50% BASX revenue growth in 26 that you've talked about, or could it be a bit better? And then comment on the light commercial market. Are you assuming sort of a flat market there? And then I think you had some price increases that came in 4Q, so I'm curious how much price you have in the guide for 26.
Yeah, so from a growth driver perspective, the growth in the basic side is not really up to that 50% range. It's definitely about half of that is sort of built into the guide. A lot of the growth is going to be coming out of the AAON brand, and in particular, coming out of the Tulsa organization. So as we enter the year, our AAON Oklahoma segment has backlogs that are extended beyond where we want them to be. That is certainly partly driven by some of the supply challenges that we've had, but really coming out of the I'll say improving supply stability, coupled with the improving velocity in the plants, you're going to see the AAON side of the business provide meaningful growth inside that segment in Tulsa. We're already seeing that as we're kind of 2/3 of the way through the first quarter, with AAON Oklahoma running near record volumes as we sit today. So certainly seeing the drivers being great growth out of the basic segment, but also really strong recovery in the AAON segment. That's going to be a huge driver of growth in 2026. On your question on pricing, so if you kind of recall last year, we had really two pricing actions. We had a price increase at the beginning of the year, and then really, I'll say a surcharge that really was in response to tariffs, but also the sort of secondary effects of price cost dynamics around the tariff backdrop. And so when we look in what was done towards the end of the year, there was really not any big pricing actions that were taken at the back half of the year on the AAON side of the business. So really that growth that you're looking at, that is really growth in volume that we're talking about going forward into 26.
All right. Thanks for the call. I'll pass it on.
I'm sorry, the one piece too, sorry, I meant to touch on is you asked the question on the commercial HVAC market and the backdrop in that sense. And yeah, to your point, I mean, the indicators and kind of how we see the market from a high level perspective is flattish in 2026. We don't see a huge recovery in the market as a whole. But really, I would say the intentional efforts that we have with our Alpha Class air source heat pump, coupled with the national account strategy, that's what's driving outperformance in our bookings and what we see as being the big driver of outperformance going into 2026.
All right. Thanks. Good luck this year.
Thank you much.
Our next question will come from the line of Noah Kaye at Oppenheimer.
Hey, thanks for taking the questions. Hey, can I just follow up on that last one? Matt, I think you said, if I heard correctly, that the guide at midpoint maybe even assumes 25% or so revenue growth for basics. And I'm just trying to foot that with where the backlog ended. So, am I understanding that you only expect to ship about half of your backlog in 26? Is that math right? And if so, why would that be the case?
Yes, it's a great question. And really, I would just start off by talking about the buying dynamics in the data center market. And the data center segment space does not trade in the sort of lead time mindset that the commercial HVAC market does. And so the dynamics that we see embedded in our backlog is, a combination of, or I should say, it's built upon a lot of longer duration, multi-phase projects and programs. And so given that dynamic, while the backlog is certainly strong and robust, there definitely is a extended period that kind of is built into that backlog. And it's allowing us to ramp with a lot of clarity, not just in 2026, but going into 2027 as well. And when we think about that backlog, there's potential for a little bit of movement in there, not as much driven by our production throughput, but really driven by just some of the constraints. We see a little bit of movement in the market, the data center market as a whole, on project deliveries, just as the entire kind of supply network, feels the pressure of the overall demand. So you might see a little bit of that backlog move in or move out, but fundamentally, it's really driven by these longer duration programs.
Okay. Can we talk about cash generation? I mean, if I'm doing my math right, you built something like $225 million of working capital in 25. Can you put some finer points around your operating cash flow generation expectations for 26? Kind of how you see the cadence of that? Are you starting to collect more on accounts receivable? And how quickly do you see debt reduction? I'm just trying to figure out how to model your interest expense.
Yeah, certainly no problem. First, I do want to, point out, if you look at the cash flows on a quarterly basis, we did see improvement in our cash flows from operations to be positive Q3, Q4 with sequential improvement. I would expect this positive trend to continue into 2026. So you can see, like at the end of the year, you'll notice our accounts receivable is up at the end of the year, highlighting our conversion of our contract assets and contract liabilities. To this point, I'll also point out the contract liability that you see at the end of the year is part of our efforts to negotiate down payments on some of these upcoming jobs, so that we can better manage our working capital and liquidity. So we do anticipate cash flows to improve through our increased earnings, through a lot of these supply chain improvements that Matt has talked about in our buying practices, and then also through increased billings and conversion of our contract assets. When you think about debt, it will remain elevated for most of the year. We expect it to come down little, maybe towards the back half of the year, but interest will be higher just given the starting point at the beginning of the year with a higher debt balance, and we expect that to remain elevated for most of the year.
All right, I'll take the rest offline. Thank you.
Our next question this morning comes from Brent Thielman at D.A. Davidson.
Hey, thanks. Good morning, Matt, Rebecca, Joe. Hey, Matt, just in terms of the composition of the BASX backlog and I guess specifically orders this quarter, is it over-indexed to one or two big orders? Is it predominantly hyperscalers, or are you getting some more traction outside of that customer segment? Just some more color around that.
Yeah. Good morning, Brent. So when we think about the backlog composition, obviously we don't dive into the exact customers that are in that backlog, but at a high level, there certainly is diversity in that customer base and increasing kind of customers inside that backlog. The one thing I always point out is, while it's great, bookings that we see in the quarter, certainly given the scale of data center orders, there's a little bit of skew, given some of the orders. So, one order certainly can represent, I'll say, a concentration in a customer in that given quarter. But what we are seeing kind of on a collective basis is introduction of new customers and introduction of diversity in customer base with hyperscalers, some of these sort of build-to-suit whole-location providers and co-location providers. So we continue seeing the efforts that we're focusing on to diversify our customer base pay off in the overall bookings cadence.
Okay. And then I guess on the AAON branded side, Matt, how do we think about sort of order intake going forward in that? I'm sure you're ramping up production in Tulsa, but you've had some challenges here. Are you taking a step back or do you feel comfortable that production levels are where you want them to be, and you're going to continue to ramp up new order intake here going forward on that side of the business?
Yeah. So on the AAON side, one thing I want to point out is certainly 2025 on the AAON side of the business does not represent the performance expectation that we hold for ourselves. And so we certainly did not deliver the throughput and the reliability that our customers expect and deserve of us. And so when we think about going into 26, we are dedicated and focused to driving operational improvements, and really increasing the execution certainty for our customer base. So that's going to result in sequential ramping of production throughout the year. So we're going to be driving productivity growth, especially in the Oklahoma and the Longview segments, really to ensure that we get back to the lead times our customers want and need, as well as ensuring that the delivery reliability is what they expect and deserve. And so you'll see strong kind of growth in the overall sales from an AAON side throughout the calendar year as we continue driving and executing on that strategy. But I do want to point out that even with the challenges that we faced in 25, we made huge investments in ensuring the support was there for our customer base. And so we've invested heavily in customer care and customer service departments to really bolster the customer experience, even in the midst of some turbulent times on the AAON side of the business. That is going to continue being things we invest in going forward to ensure the customer experience is meeting the mark for where we hold ourselves from an overall business perspective. And so when we look at this kind of in aggregate, we had a challenging year. We're driving velocities as we enter 2026 and throughout 2026 to really push more volume through our plants. But even in that challenging backdrop, you saw the bookings growth remain strong and actually increase even in the midst of that, which really kind of highlights the value proposition and the focus that we have on doing what's right for our customers, even in the midst of those challenging times. And so we anticipate, even in that, I'll say, flattish commercial HVAC backdrop, we anticipate seeing our bookings growth continue to strengthen throughout 2026, supported additionally by really good ramp-up in our execution and productivity at our plants.
Okay. Thank you.
Our next question this morning, and caller, I do apologize if I mispronounce your name. We'll hear from Timothy Wojs at Baird.
Pretty close. Good morning, everybody. Maybe just to start on the Oklahoma business, Matt. Just I guess where are your lead times at today? And I guess if you could maybe talk a little bit about how those tracked into the back half of the year. And I guess when would you expect your lead times in the Oklahoma business to kind of fully get back to normal?
Yeah, so certainly lead times are extended beyond where we want them, Tim. And, it's hard to put an exact kind of quantification on it because it does vary based on production lines and kind of product type within our plant. But they're definitely out substantially longer than where we want them to be. For some of our more kind of high volume lines, they might be in the mid 20 weeks kind of time frame, which is definitely